Yeah. Good morning, everyone, and thank you very much for coming. I wanted to congratulate you because you made it to day 3 in the WTM, which is already an achievement. So thank you for coming. Today, I'm going to talk about currencies. And even if you are not in a financial department or you are not the CFO or treasurer, this is something that is interesting for you. Okay, currencies in the travel industry are touching not just the financial department, but also sales, the purchasing, and are becoming basically a strategic part of some of the travel players that we are working with. So basically my main goal of today is to show you how currencies can play a key role on the travel industry, even if you are an OTA, a tour operator, a bed bank, an hotel chain, and basically how to use currencies as a competitive advantage for your business. Okay? So let's start. Here, basically what I try to put is the complex value chain that the travel industry have, right? We all know that there are a lot of different players. This is just an example. But from the moment a traveler books a booking until it travels to the hotel or it goes to the flight, basically it purchases the product, there can be a lot of different players in between. Okay? The idea of this graphic is basically to show you that it's really complex in terms of currencies to manage all this. There is the selling part, there is the contracting part, and what we are seeing at Cantox is that there is a bit of a fear from the financial departments and also from the treasury departments to embrace that currencies. No? And this is normal because to manage this is complex. Usually you are not collecting at the day of the booking. Usually you are not paying at the day of the booking. So to embrace currencies is not easy at all. So most of these financial departments that we are talking to, they react with fear. We tell them, look, this can be an opportunity for you in this super competitive landscape that we are. And the ones that embrace the message and they understand what we can provide for them, then they see the value of it. But of course, first we need to pass through this first phase of fear. Okay? So let's see an example. Let's see what happens when, for example, an European travel operator has different choices to purchase the same product. Okay? Let's see that. For example, this is an OTA, an European OTA, and a Spanish OTA that has the same product in dollars, in euros, and in euros. Okay? If we don't embrace currencies, we can see clearly that the best option here is option B, right? Option A is not even an option here. Okay? So the travel operator's choice in this example will be the second one. Let's see what happens if instead of having just 2 options, okay, we have 3 options. So we can buy in US dollars. Okay? When we can buy in US dollars, the option that we thought at the beginning was the cheapest one, it's not anymore. It's not the cheapest one anymore. Why is this happening? This is happening because the financial departments of your suppliers, same as your financial departments, are putting the famous markups. Okay? We are all related with this word, I guess, in this industry. But the idea of this is that if we remove the problem from our supplier and we embrace this and we manage it correctly, we can basically purchase cheaper. Okay? So the best price in your functional currency might not be the best price in the market. Okay? What we are seeing is what I was saying. A lot of companies are limiting their business because they try to purchase in the currency that they are selling. So all these opportunities that we are seeing here, they are not unlocked when they are limiting their business like this. Okay? So the idea, again, is to embrace currencies in order to, in this case, in the contracting part, to purchase in a cheaper way. Okay? Following with the example, in this case, let's say that the company already embraced currencies, so we have surpassed this fear phase, and we said, okay, we are going to buy in US dollars. Okay? And today, the US dollar rate is 117. We are more or less at this rate right now. So then the travel operator will also sell in another currency. In this case, it's going to sell to a British customer. Here, this is a B2C example, but the British customer can be a B2B player too. Okay? We can be selling to an OTA in the UK. We can be a wholesaler and buying in US dollars and selling to an OTA in GBPs. Okay? In the selling. What is happening is not just this. Is that your financial department is not buying at 117. Your financial department is buying at 113. Why? Again, there is a risk that we need to face. Okay? How do we face it? How do we embrace it? Okay, I don't want to have this volatility risk, this FX risk on my books, so I would put a markup and I would price and I would pass this to the contractors. I would pass this to my purchasing department. What is happening here is that your business is becoming less and less competitive. Yes, you are buying in US dollars, but you are buying at 113. So now the cost is not 85 anymore. It's 88.5. Okay? At the end, we are supposedly selling at 0.85. But we will see what happens in the selling side too. Let's talk about the selling side. It's exactly the same, okay? As we, in this industry, even if you are a B2B or a B2C player, even if you are a wholesaler, even if you have tight or huge margins, we need to speak, what we always say at Cantox, that we need to speak the language of the client, okay? Let me put you an example. When I go to an hotel chain website, and I want basically to, for example, I'm a Spanish customer, and I want to go to Mexico, and I buy from a Spanish hotel chain. They make me pay in US dollars just because the hotel is in the US. What I'm going to do? I'm going to go to the OTA, that is technologically a bit more advanced in this case, and I'm going to buy in euros, because this is the language that I am speaking. Okay? And in the B2B, when everything is bought through APIs, through XML connections, just this 1, 2, 3% can make a difference. If not, I don't know if you are in the wholesalers or in the bed bank space, but this can be the whole margin of one of these players. Okay, so if we remove this markup, and if we don't limit ourselves on putting these markups, we can be more and more competitive. So this happens in the selling side too. I cannot sell to the OTA in the UK in euros. I have to sell it in GBPs. Because what is going to happen, again, I'm repeating myself, but I want the message to get in. The financial department of the OTA is going to say, yes, no problem. I'm going to purchase you in euros, but you are passing me this risk, and I'm going to put a markup of 3%, 2%, 1.5, even 5%. So you don't have a control on the price of your product. Okay? And we at Cantox, we understand that companies put markups in order to surpass these FX problems or these FX risks that can appear. But we think this is not the best way to manage it. Following with the example before, we are buying at $100. We said that we are not buying at 117, we are buying at 113 because our CFO said, no, I don't want to have this risk, I'm going to buy it at 113. And this is happening almost everywhere. Maybe it's not 113, maybe it's 115, depending on where you are in the value chain of the business, of the industry, sorry. And in the selling side, it's happening the same. Hey, I'm an European travel operator. My functional currency is euros. Okay? So if I have to sell something that I bought in US dollars and I have to sell it in GBPs, I would put again a markup. I want to call myself. And this can be up on 8% of a cost. Again, this is an example. It can be 8, it can be 3, it can be 5. But this is happening in a daily basis in all the industry. It's happening everywhere. And sometimes, that's why I was saying, currencies are not just a topic for the financial department. This is core for the business, and this is core for the industry. So if we avoid this 8% over cost, of course, we will be more competitive. Then you can ask, okay, if you think you are going to sell the same at 0.89 that at 0.85, of course, sell it at 0.89, and you will sell with more margin. But I don't think this is the case in most cases. Okay, the idea here is to increase conversions and basically to be more competitive. Okay? So let me explain you a little bit what are the different risks. This is a bit small, but hopefully you can see it. The different risks that we can find in a booking journey, in the journey of a booking, since the moment is sold until the moment is collected or paid. Okay? This is just an example. Okay? Let's say we are a wholesaler, that we are basically updating our rates in order to price in different currencies for our clients in a daily basis, which is a common case that we find. OTAs usually do it once a day. Some bed banks usually do it once a day, even they have super tight margins. Okay? Another example would be maybe a catalog tour operator. Okay? This first phase, this first pricing risk would be the whole year, because they cannot change prices in a daily basis. But what we are seeing is that there is more and more dynamism in the market in order to update prices more often. Okay? So what we say always at Cantox is this first part, between the pricing and the booking, this is responsibility of the sales, the purchasing departments, and basically it's in a strategic concept that needs to be tackled. Once the booking is done, it's responsibility of the finance team, not before. The finance team cannot be the one responsible of putting this price and adding a markup, because our revenue managers are going to be a bit upset if the finance teams are basically putting a markup on the pricing. Okay? So the first part is responsibility of basically the management, and the second part is responsibility of finance. What happens once the booking is done? Usually in this industry, we are not collecting and we are not paying at the moment of the booking. Maybe an OTA, when we are selling B2C, we are collecting a couple of days after, when the PSP is settling us. But when we are talking B2B, we are collecting 30, 60, 90 days. When we have to pay, hopefully we have to pay at 90, 120 days after check-in date, depending on the payment terms that you have with your suppliers. So there is a risk here. There is this operational risk, okay, that needs to be tackled. And then we have the margin, what we say, the conversion risk. Let's say that you have sold, the example before, we have sold the room in GBPs. If the client pays to us, and we basically keep these GBPs in a GBP account, in a sterling account, and we don't exchange it, our margin is fluctuating. That's why we are saying, until you don't consolidate your margin, you have a risk. Okay? But what we are going to tackle is the operational one, from the moment of the booking until the moment of the payment or collection, depending on where the FX risk is coming from. It can be from the selling, from the buying side, or from both, in the example before. Okay? Finally, another FX risk that most of the companies are concerned is the accounting one, because this is what we see in the books. When we receive an invoice at, I don't know, at 118, and then we pay it at 116, we say we have an FX loss. But it's okay to have an FX loss if the operational risk has been tackled, because the margin is under control. It's just, let's call it, it's just an accounting FX loss. At the end, the bottom line will be better, which is I guess, we all agree that it's important. Sometimes when we talk with different players, they are just tackling the accounting one. They are forgetting all the days from the moment of the booking until the moment of the invoice. They are just focusing on the invoices. And we're like, no, your risk, your FX risk, your margin is affected from the moment of the booking. Hopefully, I didn't lose anyone. I'm repeating myself, but I want you to get it and to internalize these topics. So, what do we do at Cantox? What is the alternative of putting these markups? How do we make the businesses more competitive and more resilient? How do we make them? Why did we start with 4 currency pairs with us and they ended up with 120 without the necessity and the need of hiring people in the financial department? So basically what we do is updating the price not in a daily basis because 24 hours has passed, because most of the players, they are doing it this way. We give us some rules to our API and we say, look, we are going to update our prices when it makes sense for the business to update our prices. And when it makes sense, this is something that it's done by the management and by the revenue management teams. Maybe if the currency moves 1% in a day, it makes sense to exchange it. Maybe it's 0.5 if we are a bad bank. Maybe it's 3%. Why do we have to update it every 24 hours? Okay? And here we always say that the first mover advantage is the one that is getting the most from that. Because, again, 80% of the people, 80% of the business, they are updating it in a daily basis. Even it can be improved a lot. Okay. Once we have a pricing strategy that is better than what we have before, we have a booking, we have a sale. And as I said before, this is responsibility of the financial department. How do we manage this? Okay. What we receive is the bookings from the clients. How do we receive it? We receive not just bookings. Maybe you will ask yourself, what happens with cancellations and modifications? Of course, we need to receive exposure, not just bookings. We need to receive risk, okay, that is created. Usually we partner with booking engines, travel tech players, channel managers, because usually these players, they already have this information, okay? So once we have this information, we hedge the risk. We basically execute different forward contracts, we lock the rate, and we secure the margins. We're not going to be the ones saying, look, now it's a good moment to buy the US dollar because Janet Yellen said that the interest rates are going to increase. No. We're going to tell you, look, if you want to gain a 5%, because your business is not basically guessing, if you want to gain a 5%, you will get a 5%. How you are going to increase the business and basically the profitability of your business is by selling in the currency of the supplier buying in the currency of the supplier and selling in the currency of your client. This is how we are going to improve. Okay? So we have all these operational FX risk under control. Then, at the payment or at the collection side, it's when basically the cash flow moment arrives. How do we work? We already have the forward contracts, okay? The hedges of these bookings. It's not necessary, we don't have a hedge per booking. We basically aggregate. But at maturity, the client is sending us the selling currency and we are paying to the suppliers or to their accounts. Okay? But the key thing here is that we are paying with the rate that we already locked maybe 3 months ago. Okay? So these 4 points are key, basically, to tackle the risk in an optimal way. I will pass this one a bit fast, but basically we have 3 different set of solutions. As I was saying, the first one is the pre-trade phase. How do we make our business more competitive in terms of pricing? How do we improve our pricing strategy? Why do I have to take the ECB rate of the day before and basically rate my product on Friday, Saturday, and Sunday with a rate of Thursday at 3 p.m.? Doesn't make any sense. We need to be on the market. Okay, so this dynamic pricing solution that we have is basically an API that can help on that. The second part is the one that I explained before. It's what happens once the exposure is created. What happens once we have a risk. Basically, we will hedge it until the cash flow moment. And then the cash flow moment arrives. We can pay to the suppliers, to the currency of our clients, and we can even collect. Okay? The idea is to have the whole risk, FX risk cycle covered in 3 solutions. Of course, we have reporting analytics section where the clients can even see the P&L, the FX P&L of every booking if they want. Because the FX P&L of the booking is the rate at what we sold, this booking, against the rate at what we basically hedged that booking. We can able to tell you this. Okay? So that's all. Basically, hopefully, I didn't lose anyone. I have been repeating myself a lot because this is a topic that it needs to be internalized a lot. But basically, the idea of embracing currencies is, look, I will remove the problem of my client. I will remove the problem of my supplier. Basically, I will remove the markups that they are putting in order to tackle this problem. And this will help me increase bookings, of course, protect the margins, because we cannot embrace currencies if we don't have a software that protects our margins. Unlock growth opportunities, as I was saying, usually we start with companies that they have 2, 3, 4, 5 currency pairs, and they ended up with 50 currency pairs, 60, 70. They don't care. They basically see this problem as an opportunity for them. Okay? And of course, gain a competitive edge. I was saying before that in this industry, the first mover advantage is super, super, super important. It's a super competitive industry. So the first one that is playing this in an optimal way is the one that is going to have the most competitive edge. Thank you very much.